Hey, good afternoon and welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. And this is where we're going to cover a strategy called stock replacement. It's real simple. What we're doing is we're using longer term call options. And for those of you that have never traded an option, think of it this way. You have a really expensive asset. You're concerned that that asset may lose some value in the near term, but you want to continue to participate in the appreciation of that asset going forward, let's say for the next 3 to 6 months. And you're sitting there going, well, how can I do that by taking off most of what I already have invested, but use a portion of that capital to participate on the upside? So you're removing capital risk. Well, an easy way to do that is to replace your stock with a longer term in the money option. Stock trading at 50, we're going to buy an in the money option. Now I'm going to get into the mechanics of this, but before we do that, we'll do a market recap, just tell you what's going on at noon, and we'll get started. Now, by the way, for those of you that are new, and there's a lot of new viewers these days, so thank you for tuning in. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. Now, just doing a quick overview of the market. You see that the markets are actually in the green. It's been a challenge all day, to say the least. The Dow Jones is still waffling around the 50-day moving average on a shorter term time frame. That's a 30-minute chart. If you just look at the daily chart, still the bulls are in control, whether it's the Dow, whether it's the S&P 500. But where we are seeing some uncertainty is in the NASDAQ, continuing to challenge its 20-day moving average. We're going to watch that very closely. But the small caps have continued their upside move. So those domestically centric stocks that would be sensitive to data. We had the durable goods that came out a little worse than expected. So the fact of the matter is there's going to have to be some catalyst on the economic fronts very soon if we're going to start to see GDP forecasts here in the States moving forward. But with that being said, and with those types of headlines and risks and mixed economic data, I want to walk you through an example of how you could use longer term options, as I was discussing in the beginning of today's discussion on Strategy Now. We use longer term in the money call options to replace your stock. It's quite simple, and we'll walk through the process of how to do that. So I'm actually just going to jump in here, and here we go. So the bottom line is, what are we trying to do? Well, we're trying to replace high-flying stocks that have appreciated in value, and we're going to use in-the-money conservative option strategies. Now, one thing that I want to note is that whether or not you know what a call or a put is, at this juncture is not too important. But what we're going to focus on is a call. And a call option appreciates when the market goes up. Now, does it appreciate penny for penny? No. As a matter of fact, does the selection of the strike of the option you're buying, think of it as insurance. If you know that you're going to get really sick, or you know that you're going to have a fire in your house, or you know today that when you walk out of this house and you get in your car, you're going to get into an accident, you don't care what price you pay for that insurance because you know with certainty that's going to happen. If you do, then buying that insurance and paying any price is going to make sense, because whatever premium you pay for that insurance, knowing for certain that that's going to happen, it's worth it. But we don't know that. It's a random type of situation. You don't know if you're going to have damage to your house, to your car. You don't know if you're going to get sick. But the point being is that if you have the inclination that it could happen, it might happen, then you're going to start shopping around for products that are going to protect you. So in this case, let's say, for example, I bought a stock, we'll just call it USB. I bought 1,000 shares. I bought it for $35. And as you can see from this graph, if you buy a stock, if the stock goes up, you make money. If the stock goes down, you lose money. So with that knowledge, and knowing that I have now $35,000 in 1,000 shares, I look and I say, wow, the stock's up 41 bucks. I've made $6.40. That's a sizable profit. You're seeing a $6,000 profit in this underlying. And you're going, well, now I have 41,000. Let's say this industry, has some risk to market economic data, has some risk to interest rates, and also if the economy doesn't grow as fast, this stock could come under pressure. So having $41,000 wrapped up in it, you might have some uncertainty. But you're sitting there going, I really like the continued prospects of the shares. Well, what do I do? Well, if you continue to like the prospects of the shares and you think that that's going to continue to transpire through 2017 and you want to have a controlling interest in participating in the upside, but you want to limit their downside risk, you're going to want to look to buy calls. Okay? In this case, you're going to replace the 1,000 shares that you own from $35 with an in-the-money call that's expiring, let's say 6 months from now. Let's say January of 2018. So I'm going to buy the January 2018 $35 calls. They're called leaps or longer-term equity options. And I'm going to pay $7.35 for that call. Okay? Now, when you do this, buying that call now has some positive components, especially since the biggest one is that you want to remove the capital risk. Okay? First of all, you're now limiting your downside to the premium you pay. So if you buy 10 contracts and you pay $7.35, multiply that $7.35 times 10, and then multiply it again by 100. That basically gives you a total risk of $7,300, as you can see from the graphic. You're also seeing that once the stock goes below or to $35, I'm not losing any more money, unlike the stock, which basically you have risk to zero. Now, this frees up over $34,000 for basically the next 6 months. All right? That means that you can go out and put on multiple positions, maybe diversify your account a little bit more, or maybe there's some higher interest rate debt that you want to get off of your sheets. That you're looking to pay back now that you know that interest rates have been moving up. The Federal Reserve moved up interest rates. This does give you unlimited upside, but I'm going to asterisk that because it's only until the expiration of the option, which is January of 2018. Now, the potential risks are very clear. First of all, unlike when you own the stock, if this stock pays a dividend, and I'm buying it now in the July time frame, you're going to miss 2 dividend payments. All right, I'm willing to have that trade-off, and I'll show you why in just a minute. You don't have voting rights. So if you do take advantage of the voting rights on a stock, you don't have any when you own an option, specifically a call option, even though you own the right to be long stock from the strike price, $35. You bought that right for $7.30. That's all you've bought at this juncture. You would have to exercise this right. Now, the other trade-off is your break-even isn't penny for penny. So if the stock goes up a penny, unlike when you own the 1,000 shares, the options, they'll improve in price, but not exactly at the same rate as the stock appreciation until you get above what's called the break-even point, which in this case is $42.30. How did I come to that? I take the strike price, $35, and I add the call price, $7.30. You add those together, that gives you $42.30. Once the stock gets above $42.30, between now and January expiration, you're going to see that this option is going to be trading almost step for step. So there is a trade-off there. With the stock trading at $41.30, you still have what we call some extrinsic or time and volatility risk, because these are decaying assets. The last thing is that you still do have capital risk. Believe me, you're not eliminating all of it. You have $7,300 of capital risk. But that is far less than the $41,000 that you had when you originally owned these shares that are currently trading at $41 and some change. You've eliminated over $34,000 worth of risk, and you're still participating on the upside. Now, if you ever have any questions about what I just talked about, I know it's a lot to take in. You can always email me at this email address, jcusick, J-C-U-S-I-C-K, @moneyblock.com. That's where you can go in and you can actually check out this particular video and also to get me any questions. As a matter of fact, what we're going to do at the next strategy now is I'm going to show you how to actually develop a dividend stream after you've instituted one of these long calls in the longer term options. I'm going to show you how to do what we call a poor man's cover call. That'll be next strategy now. Till then, folks, if you ever have any questions or considerations, just come to MarketStream.live. You can email MarketStream at info@MarketStream.live. You can email myself at jcusick@moneyblock.com. And as always, go back and take a look at all the videos on our Facebook page as well as MarketStream.live to review what we've covered today. Well, that's it for strategy right now. I appreciate everybody coming in and learning how to replace your high-flying stocks with options so you're reducing your capital risk in an uncertain or potentially uncertain market. We'll see you later this afternoon when we're going to talk about everything that's going on in the marketplace after the close. See you then here at MarketStream.live.